Welcome back to Switzer. This is a question I've always been interested. Australians are always advised to monitor their super fund for performance and for cost. But what happens when you decide to leave one fund and go to another? Does it trigger a capital gains tax event? And what about if grown-up children in a family in a self-managed super fund decide to leave the fund? Once again, is there a capital gains tax ahead? To answer these questions, we have Graeme Colley from SuperConcepts. He's the SMSF Technical and Private Wealth Executive Manager, which is arguably one of the longest titles in the history of titles. How are you, mate?
Good, how are you?
I have actually seen longer ones, Graeme. Now, Graeme, I get this question all the time, you know, and let's start off and just explain what happens. So let's imagine I'm in X super fund and I do my homework and I find this fund has historically performed better and is a reasonably low cost fund. I do a switch and let's imagine I've got, say, $500,000 in my super fund. Am I going to be slugged with a capital gains cost in doing that switch?
Well, not on the actual superannuation transfer, you're not.
No.
But within the superannuation fund, if your fund is on a unitised basis, then incorporated in the accounting for that unit price is what we call an accruals basis of capital gains. So they'll work out the approximate capital gains that could be incorporated in the value of that unit. So that's how that works for the biggest superannuation funds that are on a unit basis.
Yeah. So when you think about it, if someone's got $500,000 and they've ridden over some fantastic improvements in share prices, like CBA, for example, they could actually have quite a significant capital gains bill, couldn't they?
Oh, quite so. With CBA, for example, if you're in accumulation phase, as you might with young people, you've seen CBA rise quite a bit over time. And yep, if you're in accumulation phase, you're chugging along there, just saving up for your retirement pension that you might draw down, and you move over to another fund, then for that self-managed fund particularly, there'll be a capital gains tax event.
Yeah, and when you think about it, the capital gains cost could actually offset a lot of the benefits of the switching to another fund.
Possibly, that's right, yeah. But don't forget, if you've held the investment for longer than 12 months, you get a 1/3 capital gains tax discount. Yeah. So you do get a bit of a free kick, I suppose, if you call that.
Yeah, it'd be interesting to see. I'm sure some of my viewers at some stage in their life have been given a real surprise. But I guess in many ways it actually tells a lot of young people to be really more diligent about their super fund, because if you switch later in life, that's when the capital gains event is going to be a lot more costly.
That's right, because the longer you've held those investments, the more likely they are to increase in value, and then the more likely you end up with the capital gains tax event. Okay,
let's look at the situation of very caring parents. So, the parent is a very good investor and has done very well in a self-managed super fund. Their children start work, and the father says, "Why don't you join our self-managed super fund?" And the children say, "Yeah, Dad's fantastic at investing." So they do. And along the way, Dad gets a bit old and starts becoming very conservative, and the younger members say, "Hang on a minute, I need to be more exposed to the stock market. I'm being held back by Dad's conservatism or Mum's conservatism." Is it easy to segregate inside a self-managed super fund?
Yeah, what you can do is each member can have their own investment strategy, and they can have investments which are dedicated just to them. So if you've got Mum and Dad who are going a bit conservative because they're thinking...
And chasing dividends, like the Switzer Dividend Growth Fund or something like that.
Absolutely, something like that. Yeah. And then you're a bit younger than that, maybe 30 years younger, and you're thinking, well, I need a growth investment. Then you can certainly split up the fund into each member. Yeah.
And so then would you have to have 4 investment strategy statements if you're doing that? Because a super fund is supposed to have an investment strategy statement. If you segregate into 4, do you need 4?
Well, you don't need 4 investment strategies. You need enough. The strategy needs to cover the fund, and then as a sub sort of strategy under that, each member can have their own strategy and then fit their own portfolio within that.
Okay, so all right, so that's I've come up here with an interesting example where someone decides to leave the super fund, and you let's imagine then that the total value of the fund. There's not going to be hard numbers, Graeme, so don't panic. Okay. But imagine there's $900,000 in the fund, and 2/3 of the contribution have come from the parents and 1/3 from the child. Okay. Now, obviously, because the child's going to leave, that will trigger a capital gains tax event.
If they're in accumulation phase, because if the child's in pension phase, and some
No, we're not in pension phase. We're in accumulation phase.
Yeah.
Is it possible, because ultimately it's $300,000 needs to be taken out of this fund, is it possible for the fund to decide to purely sell the shares that have capital losses to avoid getting capital gains? Or must they divide up? Imagine there's 10 stocks in there. Do they have to divide up the 10 stocks in there on a proportionate basis? 2/3 of each stock has to remain in the fund, and a third. So,
it's nothing as complicated.
Yeah, because that does give a potential strategy for someone. Okay, well, we'll just sell the capital losing stocks. As long as they get 300,000, they take it away. Is that what you're saying?
Well, you could do it on that basis, but usually what the trustees do is they say, well, what money have we got there to be able to provide for that $300,000? Okay, is that in cash? Okay, well, maybe they do have some in cash, so they can use that, and then they might have to use some stocks there and sell those off. So they can sell all their BHP or CBA shares.
Yeah. No, because there's capital gains on those.
Yeah, but I mean, you'll have to sell something sometime, won't you?
But I'm saying, if they actually do have $300,000 of capital losing stocks, they're quite entitled to sell those.
They can sell any investments they've got, providing it's within their strategy, and I'm sure that would be.
Yeah, okay. Well, not that I'm giving any advice here. This is purely my educational observation, but it is an interesting one. In fact, I was asked that very question by someone who had thought it through. So in terms of over the years, you've looked at a lot of self-managed super funds and, kids joining in. Do you think it's a good idea?
Well, for some parents, the family gets on very well together, and I've seen it work incredibly well. In other cases where mum and dad may not agree, they might have different investment strategies, and then the kids come along and they've got their own ideas, that can cause a bit of tension in the fund. Also, if one of the parents was to die or one of the children was to die, the voting structure of the fund might change, and that might sway the investments of the fund in one way or another. So I think you really need to, pick horses for courses and make sure that the family's going to be quite harmonious in the way it operates. Sometimes I've seen it where the kids have got their own super fund and mum and dad have got their own fund too.
Okay, mate. Well, AMP SuperConcepts, if people go to the website, can they get information around this sort of things?
Yes, they can. Definitely.
Right, great. Good to see you, mate. Okay. That's Graeme Colley from AMP SuperConcepts. Coming up after the break, Chain Reactions founder Barrie Wilson and JLL Regional Director Andrew Harvey will join me at the desk to talk about their interesting charity.